Vice Chairman Hensarling.
Thank you, Mr. Chairman. Good morning, Chairman Bernanke. I want to follow up on a line of questioning of our chairman dealing with the long-term structural debt of the U.S. Certainly when I talk to CEOs, frankly, small business people in East Texas that I represent in Congress, this is a great concern, one that I believe is impeding economic growth. In fact, I woke up today, and while I was putting on my tie and watching television, Mike Jackson, the chairman and CEO of Auto Nation, stated that his #1 concern was the national debt. A year ago, you said it would be very helpful to put the nation on a credible plan for fiscal exit, and most recently, you have used the term critical threat. So my question for you is, with the passage of 1 year, do you have a greater concern about the nation's fiscal trajectory? And do you hear what I hear from job creators in our economy, that this is becoming a greater impediment to economic growth today?
It remains a very significant risk for the same reasons that I described before. It affects confidence. It affects expectations of the future. It, on the margin, may affect interest rates either now or in the future. So it remains a very serious problem. In terms of progress, clearly it's become a more central issue in the congressional debate, but so far, and we've seen also the results of the various commissions and the like, but obviously so far we've not really seen any concrete measures to address the longer term concerns that still leave us certainly on an unsustainable path going forward.
Let me ask you a question about QE2. You and I have had the opportunity to discuss. You know, I'm not particularly a fan of QE2 because I very fundamentally view September of '08 differently than March of 2011. Again, I believe in statistical evidence. I also believe in anecdotal evidence. Folks I talk to have a greater concern over the fiscal trajectory of the nation. They have a greater uncertainty about tax policy. They have a greater uncertainty about the regulatory burden of Obamacare, of Dodd-Frank. That's what I'm hearing. I believe there are limits to what monetary policy can achieve, particularly if I've observed correctly. The last data I've seen out of the Fed is that public companies are sitting on roughly $2 trillion of excess capital, banks about $1 trillion excess. We appear to be awash in liquidity, and we're in an environment of negative to zero real interest rates. Clearly a number of respected economists, and frankly, as you well know, more than one of your regional Federal Reserve presidents have indicated, I guess, concern as well. So my question really is the timing. As I looked in your testimony, I'm not sure you directly addressed the timing of the end of QE2 besides its natural termination in June. Today, are there any conditions that you see that you would anticipate a QE3?
Congressman, that has to be a decision of the committee, and it depends, again, on our mandate. What we'd like to see is a sustainable recovery. We don't want to see the economy falling back into a double dip or to a stall out. And obviously we're looking very closely at inflation, both in terms of too low and too high. So I want to be sure that you understand that I'm very attentive to inflation and potential risks for inflation, and that will certainly be a major consideration as we look to determine how to manage this policy.
As you well know, a number of people and economists are concerned that the Fed is monetizing the debt. You and I have had an opportunity to discuss this. I understand the arguments on both sides. Let's put reality aside for the moment and let's talk about perception. There is, as you well know, particularly in international markets where we have seen commodity prices spike, a number of these are dollar-denominated transactions. We know that there is movement within the G20, I think within the IMF, to make moves to where the world's reserve currency would no longer be the dollar. I don't know if you saw it. There was a piece in the Journal this morning entitled "Why the Dollar's Reign is Near an End." Did you happen to see that piece this morning, Professor Eichengreen of Berkeley?
I didn't read it carefully.
And I know my time is running out, but by his calculations, because of the perception that the U.S. is monetizing its debt, he believes that the dollar will fall roughly 20% and that our U.S. living standards will be reduced by 1.5% of GDP. So the real question is, regardless of the reality of your actions, if the perception causes the dollar to no longer be the world's reserve currency, what are the implications of that?
Well, first, I don't see any evidence that that's happening, so let's be very clear about that. If the dollar was no longer the reserve currency, it would, on the margin, probably mean that we would have to pay higher interest rates to finance the federal debt, and that would be a negative, obviously. On the other hand, we might not suffer some of the capital inflows that contributed to the boom and the bust in the recent crisis. But again, I know there was also a countervailing argument in the journal this morning as well, and I just don't see at this point that there is a major shift away from the dollar. I would add also on the commodity prices that first, that the fears of some foreign governments that we were, quote, manipulating the currency, by which means we were reducing the value of the dollar, have not come true. The dollar has not moved very much at all, and commodity prices have risen just about as much in other currencies as they have in terms of the dollar. So while I take those commodity price increases very seriously, I don't think that they're primarily a dollar phenomenon.